simply, it's a mess. It's a real mess. And this is a fiscal mess without the stock market or the economy being in trouble. I mean, the last two times the stock market went down substantially in the '08 bust and in the 2000 bust, you had enormous deficits following it. You had an enormous unemployment following it. And so if our stock market gets broken at some point, then I think I'll move into kind of the next point, which is I think we know how the Federal Reserve is going to have to respond. And I call it the big print. Mm-hmm. I mean, they're just going to have to, go back to QE, go back to ZIRP, maybe do yield curve control.
Lawrence Larry Lepard, an investment manager, sound money advocate, and gold stock fund manager, believes we are on the verge of what he calls the big print, the inevitable moment the Federal Reserve is forced to come to the market's rescue by printing tens of trillions of dollars to save the U.S. economy. Lepard's perspective on the big print is deeply connected to his views on the U.S. national debt and its unsustainability. He argues that the U.S. debt has reached levels that make traditional repayment unfeasible, especially given the current economic trajectory. With interest rates rising and deficits growing, Lepard sees a breaking point where the U.S. government will resort to large-scale money printing to service its obligations and manage the economic fallout. Lepard describes this scenario as inevitable due to decades of fiscal mismanagement, where governments consistently spent beyond their means while relying on fiat currency systems. He believes the Federal Reserve's tools are limited, and the only politically viable solution will be to inflate the debt away through massive monetary expansion, what he refers to as the big print. This, however, will further debase the U.S. dollar, intensify inflation, and erode public trust in fiat currencies. From his perspective, this creates a pivotal moment for hard assets like Bitcoin and gold. He argues that these assets, being finite and resistant to monetary manipulation, will become safe havens as people seek to preserve their wealth amid a deteriorating dollar. Lepard recently discussed his views on the coming debt crisis and the impact of safe haven assets like gold in an interview with Kitco News, highlighting how gold's price will soar sharply when the Fed starts its inevitable handouts. We will bring you clips from the interview. But before we do, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. We appreciate the support and hope you enjoy the video.
Debt to GDP in the United States is about 124%. And we've got a fiscal train wreck going on, and the government, what happened is the government spent a lot of money during the COVID event, and they never cut back. In fact, they stepped on the gas. And so we just finished a year where they spent $6.75 trillion, which is almost as much as they spent in the peak year of COVID. And we've got an economy that's full employment, close to full employment. And we've got, a stock market that's at record highs. And of course, they did this to try to win the election, and they weren't successful. But I think that's part of the reason why they were so profligate. And, really until Trump won, and now they've created this DOGE committee, there's been zero discussion about the debt problem, but it's a big problem, and it's going to cause serious economic issues. It's hard to say. I mean, so as you know, this DOGE committee, Ramaswamy and Elon have decided they're going to try and cut $2 trillion in annual costs, and my response to that is good luck. I mean, I'm all in favor of what they're trying to do, and I do believe they will cut some costs, no doubt. There is some government fat, but as I said in the speech I gave here a few days ago, 80% of the money that's spent by the federal government is in the big four categories, which are Social Security, Medicare, defense, and interest. And those are very hard to touch. Go after entitlements, that's like the third rail. Defense, maybe they'll take some money out of that if they get peace in the Ukraine. But the interest costs continue to ramp every year, and defense is pretty untouchable as well, although maybe they'll be able to cut something there. The remaining 20% is the rest of the government. And even if they take a hatchet to that and cut 30% of that, it's a couple $100 billion a year in savings. In a year where, last year they ran 1.8 trillion in deficits, and this last 6 months annualized, the deficit run rate right now is $2.4 trillion. So, let's just say, give them their due. Maybe they cut $400 or $500 billion, and that would be hard to do, but maybe possible. It would still only take you from 2.4 back to where we are now, 1.8, 1.9. And the point is, the slope of all the curves is accelerating very steeply. Interest cost, federal spending, deficit, et cetera. And this is going to lead, in my view, as I've said many times, is going to lead to a sovereign debt crisis and a currency crisis. And you can already see that. I mean, the evidence that that's taking place is that Bitcoin's at record highs and gold's near record highs. And I mean, gold was at a record high just recently, just backed off a little bit. But, gold started the year under 2070, and now we're playing around with 2,600, 2,700. Bitcoin started the year, at 58, or well, no, actually it was even lower than that, I believe, but it was at 58 for a big part of the year. And of course, now we're pushing up against 100. So these two sound money assets, sound money alternatives, things that could be a neutral reserve currency, they know it. They can see the problem. And they're responding.
So what do you think? Do you think the average population, I mean, we've been watching these inflows. Do they understand?
No, see, that's the thing. I don't think most people get it. I think a lot of people look at this and they, particularly, I mean, I noticed in the gold space, the gold stocks, as you know, and as I've talked about other podcasts, really haven't responded the way they should have. Gold's up 30%, the stocks are up 30%. Typically, the stocks are 2 to 3x the gain of the underlying metal. And in this case, that has not happened. And the reason for that is if you go on Bloomberg and you check the future forecast, nobody thinks the gold move is real. Everybody thinks, oh yeah, it's at 26, but it's coming back to 2,000. And the ASICs, which is the all-in sustaining cost of mining an ounce, are going to continue to march up with inflation. $2,000, pretty soon your margins are gone, right? And so what's got to happen is there's got to be a shift in psychology where people say, oh, this is the real deal. And gold's not stopping at 25 or 26. Gold's going to 3, and then it's going to 4, and then it's going to 5. And I think those things are happening, obviously, over a course of several years. But until they get this fiscal thing solved, and it's not an easy fix, to me, it's very, very clear that we've got inflation in our future.
Like many other prominent analysts, Lepard believes there is a small window opportunity for the Donald Trump administration to turn the economic situation around before the collapse begins. However, he is skeptical that the administration will be fully equipped to tackle the problems without immediately losing popularity with Americans. Lepard also commented on Elon Musk and Vivek Ramaswamy's DOGE plans. Elon Musk and Vivek Ramaswamy have introduced the Department of Government Efficiency, DOGE plan, aiming to reduce federal spending and streamline government operations significantly. They propose leveraging recent Supreme Court rulings to challenge and remove federal regulations they deem unauthorized by Congress. DOGE is positioned to help the Trump administration identify and roll back rules, cut redundant jobs, and achieve an estimated $500 billion in savings annually. Targeted areas include funding for organizations like Planned Parenthood, international aid, and public broadcasting. The plan emphasizes using advanced technology and legal strategies to halt the enforcement of certain regulations and recommends further reviews. Musk and Ramaswamy argue that eliminating excessive regulatory constraints will reduce bureaucracy, stimulate the economy, and empower individuals and businesses. Lepard is skeptical that these proposals will be fully allowed to play out and sees the Fed quickly reverting to their usual tool, printing more money to debase the dollar further. Let's get back to the interview.
It's a mess. It's a real mess. And this is a fiscal mess without the stock market or the economy being in trouble. I mean, the last two times the stock market went down substantially in the 08 bust and in the 2000 bust, you had enormous deficits following it. You had an enormous unemployment following it. And so if our stock market gets broken at some point, then I think I'll move into kind of the next point, which is I think we know how the Federal Reserve is going to have to respond. And I call it the big print. Mm-hmm. I mean, they're just going to have to, go back to QE, go back to ZIRP, maybe do yield curve control. I mean, and we're already starting to see that. I mean, I find it extremely interesting that the bond market, here they are, they've cut interest rates, and yet the longer bond, has gone up since that interest rate cut. And I'm kind of like, wow, how did that happen? Doesn't make sense.
In your presentation, you said that it's only a matter of time. This big print is coming, as you just mentioned. The Fed's balance sheet will go over $20 trillion. Elaborate on this. How soon? What does that look like?
Some people say that's hyperbolic, but it's not if you really look at the trend. I mean, if you look at what they created in the dot-com burst, if you look at what they created in the GFC, if you look at what they created with COVID, each one gets progressively larger, right? It took Bernanke 4 or 5 years to print a couple, trillion, 2-3 trillion. It took Powell six to 18 months to print 5 or 6 trillion. So it was really kind of nuts. And And I think that in order to save the next one, they're going to have to spend, it's going to be kind of unlimited. I mean, he will have to do what I call a Mario Draghi, which is he'll have to say, whatever it takes.
Yeah.
and it's going to, my sense is it's going to take a great deal if the stock market comes off hard. And so to me, that the two things that I'm watching that I think are the big triggers, I'm watching the bond market and I'm watching the stock market.
Timeline though, this year, like what you worry?
I don't know. Nobody knows, right? But it feels like we're getting close. I mean, we know that the bond market, when the 10-year gets over 5, we know they have a problem. That happened in September of 2023, and they immediately came out. 12 Fed governors came out and started jawboning it down. So it kind of 5% on the 10-year seems to be like a trigger point. The stock market, I don't know. It just keeps on rolling, and it could roll higher. There's a guy I respect, David Hunter, who's on Twitter and is ex-Fidelity manager, very seasoned, and he thinks we melt up to 7,500 on the S&P. And for all I know, we could. I mean, there's a lot of excitement around this new administration. But if you look at Hussman's numbers or any of the valuation metrics, like the Buffett indicator and PEs and price to book, well, book doesn't matter anymore, but you look at all the valuation, we're redlined, like we're right at the top. I mean, markets don't get more expensive than the stock market is right now. They just don't. And so when does that end? I don't know. I mean, maybe it could get more expensive still. I'm not shorting it, but I surely tell my clients, I don't think that's an area where you want to be heavily long.
If the Federal Reserve were to print $20 trillion, it would likely lead to a significant rise in gold prices due to the fundamental economic dynamics involved. A substantial increase in the money supply typically causes inflation, as more dollars chase the same amount of goods and services, reducing the currency's purchasing power. Gold, historically viewed as a hedge against inflation, would become more attractive to investors seeking to preserve wealth, driving up its demand and price. Additionally, the dollar's value would likely decline as such a large monetary expansion undermines confidence in its stability. Gold, priced in dollars, would naturally rise in response to this devaluation, as it would take more dollars to purchase the same amount of gold. Market sentiment would also play a crucial role. Fears of economic instability or hyperinflation would push more investors toward gold as a safe haven asset. Historical precedents, such as the Federal Reserve's quantitative easing programs during the 2008 financial crisis, showed similar effects, where gold prices surged significantly due to monetary expansion and inflation fears. If $20 trillion were printed, gold prices could reach unprecedented levels, potentially exceeding $5,000 or $10,000 per ounce, depending on the global economic response and investor behavior. Please share your thoughts on Lepard's predictions for gold and the U.S. economy in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.